Good evening and welcome to this analysis on the Union Budget 2021. Now, when we look at a budget for as large, diverse and complex a country as India, there can generally be no budget that is totally good or totally bad. There will be certain interesting aspects of the budget, some more important than the others. So in this time's analysis, as in previous cases, I take each aspect that is worthy of analysis on its own merits, and I will comment about it as we move through the budget. For those of you who find this presentation useful, you can get a copy of this presentation by email if you send me a mail at this email ID, investments_sac@yahoo.com. And for those of you who have joined a WhatsApp group created for this purpose, I will probably post this presentation on that WhatsApp group too. 1 or 2 days before the Union Budget, we have the annual economic survey. And I make a 1-minute mention about this survey simply because it is a very useful document that is available to every citizen of India free of charge to understand what exactly goes on in the Indian economy. When we look at the economic survey, the annual pre-budget economic survey is a paper prepared by the Ministry of Finance. It is tabled in Parliament by the Finance Minister, and it is the officially stamped and signed version of the state of the economy. And this entire budgetary document, along with other budgetary documents, is available to you on the website that I have mentioned there, www.indiabudget.gov.in. Now, the document is complex. I'm not saying that everyone should download and read it unless you are a very serious student of Indian economics. But it is a treasure trove of information with some very insightful comment. So it would be good if many of us who are interested enough to be present for this analysis of the budget take a little trouble to have a look at the economic survey and be aware of what is going on in the economy of our country. As usual, I will quickly deal with government finances because this little oversight helps us understand both the budget and the context in which the budget proposals are announced. We start, of course, in lighter vein with this little cartoon. The budget is nothing but a document that seeks to guesstimate the revenues of the government that are going to come in the next financial year, and also the expenditures that the government will incur. And when we talk of revenues or income and expenditure, there is always a demand for government budgetary allocations. Various ministries, various organizations, even individuals have a great interest in having access to the maximum possible budgetary allocation, whether for their constituencies, whether for their organizations, or whether for their ministries. So the government tries as far as possible to conserve what it allocates. But the constituents of the government, the states, for example, they want to grab the maximum possible that they can to develop their own states as well as develop their own power structures. Now, for normal people like us, a quick look at two vitally important measures of the economy will help us understand this whole issue of government finances as well as the health of the Indian economy much better. And those two measures are, one is the gross domestic product or the GDP, and the second is the gross fiscal deficit, or simply called the fiscal deficit. So let us start with the gross domestic product. And the GDP, a little bit of humor here, which I came across on the internet. Someone saying that I visited North Korea a few days back and left one of my bags behind by mistake. On the bright side, I raised their GDP by 0.5%. When you have economies as miserable as the ones you'd find in Venezuela, for example, or North Korea, even the smallest, tiniest asset can sometimes make a difference to the GDP. But the gross domestic product is a measure that is useful in knowing exactly how healthy our economy is, especially from the point of view of economic performance. And here's the definition of GDP, that the gross domestic product is the total market value, this is important, it's the total market value of finished goods and services produced in the country in a given year, plus the income of local residents from investments made abroad, minus the income earned by foreigners from the domestic market. So essentially, if you see the very first line of the definition, the total market value of something that is economically useful, whether it is goods or services, something ready to be sold, something that has been produced. So the value concept of the GDP is very important. And once we have a grasp of what the GDP means, then we use the GDP to translate into numbers and to tell us exactly how healthy the Indian economy is, how it has been performing across the last few years, what can we expect in the future. So if you take it as a number, it's a huge number. The revised estimates of financial year 2020-21 put the Indian GDP as 1,94,81,975 crores. As you can see, it is a huge number. And just as a number, it really has no meaning. What is important in GDP is the growth rate. How are we growing? And when you look at that, I'm afraid, the situation over the last 5 years does not look good at all. From 2016-17 onwards, we have a decline in the growth rate. 2016-17 was a pretty healthy 8.3%, and then we have dropped in the next financial year to 7%, 2018-19 6.1%, 2019-20 4.2%, and then we have the effects of the COVID-19 pandemic so visible in the GDP growth rate, we come to minus 7.7%. So a shrinkage of almost 12% across these two financial years. Of course, the COVID-19 was what we call a black swan event, something that happens very rarely, but something that can have enormous consequences on the economy. But here the point I want to make is that even before we had the COVID-19, if you look at those 4 financial years on your screen, that went before the COVID affected financial year, the picture of the Indian economy has not been good. Let's go to the fiscal deficit. We start in lighter vein about what is budget day. It's that day of the year when I look up the meaning of the term fiscal deficit, only to forget it the next day. And once more in lighter vein, balancing the budget. Two options for balancing the budget: add a zero or move a decimal point. I really wish it were that simple, but here is where the humor ends, because now we confront reality when we try to understand the gross fiscal deficit. What is the gross fiscal deficit? The fiscal deficit is simply the extent to which the government has to borrow to meet its expenditure after it has exhausted its income streams. Like any normal individual, the government has its income, which it calls revenues. The government has its expenditure, both on the capital side and the revenue side. Income, expenditure, we'll keep it simple. Generally, it's a very happy situation if my income exceeds my expenditure. But the government has a long track record of its expenditure exceeding its income, resulting in various kinds of deficit. And to bridge the gap between its expenditure and its income, it has to borrow. And the extent to which it has to borrow is called the fiscal deficit. Now, the fiscal deficit is an interesting measure where the government is concerned, because the fiscal deficit can be relative. In years of very good economic performance, the fiscal deficit will not look very alarming. And that is why the fiscal deficit is always expressed as a percentage of GDP. Here's the relationship between the two: the gross domestic product and the gross fiscal deficit. Now, let's come to India's fiscal deficit. And this slide also can be very enlightening. In 2019-20, the actual fiscal deficit of the government of India amounted to a huge figure of rupees 9,33,651 crores. More importantly, it was 4.6% of the GDP. This was our actual fiscal deficit. Now, by economic standards, which the government of India accepts, it is healthy if the fiscal deficit is not more than 3% of GDP. In 2019-20, the true figure was that not just 3%, we are pretty far away from 3%, we are 4.6% of GDP for the fiscal deficit. When the budget for 2020-21 was announced, we are talking about the previous budget of 2020, BE, or the budget estimate, it was estimated that in the current financial year in which we are living, 2020-21, the fiscal deficit would be 7,96,337 crores, or 3.5% of GDP. So there was an intention of the government to move towards fiscal prudence, to steadily decrease the fiscal deficit from 4.6%, which was the actual figure, to a targeted figure of 3.5% of GDP in financial year 2020-21. But what happened? COVID-19 happened. And you can see, far from making the journey from 4.6% to 3.5%, the fiscal deficit just balloons upwards to 9.5% of GDP. And if you look at the actual figures, we wanted the fiscal deficit to be 7,96,337 crores. We end up with 18,48,655 crores, more than 2.5 times, 2.75 times more than targeted. Why did this happen? This happened because the government of India was forced to pump in money into the economic system in tranches, coming out with various levels of stimulus to see that the economy did not keel over and implode. So in a situation as drastic as COVID-19, you cannot really blame the government for losing control over fiscal prudence. But when we look at these figures as concerned citizens of our country, we will know exactly how serious the matter is. We had estimated 7.96 lakh crores. We end up with 18.48 lakh crores. We wanted to target it to 3.5% of the GDP, the fiscal deficit, which was very close to the ideal situation of 3% or lower. Instead, we go very far from it. We go to 9.5% of the GDP, most unhealthy but necessary in the kind of extraordinary times we are living through. So now we come to this year's budget. Once again, we have the budget estimate for the next financial year of 2021-22, and even there, you can see the figure is quite large, quite unhealthy. In percentage terms, 6.8% of GDP, very far away from the 3% that is ideal. And even whether the government is going to be able to achieve even 6.8%, reduce it from 9.5 to 6.8, there is a question mark hanging over this. Anyway, we sincerely hope the government can come out or achieve a significant reduction in the fiscal deficit. Let us go to the economic environment. Why is the economic environment important? Because the union budget must be viewed in the economic context in which it is presented. A budget is not a standalone thing. A budget reflects economic reality. The reality, history, as well as future prospects. From 2014 onwards, India has been facing probably the worst debt crisis in its history as an independent nation. See, from 2003 to 2013, we had largely a good economy, especially from the years 2003-4 to 2007-8 till the global financial crisis. We had a vibrant, dynamic economy in India for 4 to 5 years. There was all-round growth. One of the sectors that contributed to that growth was the real estate sector, which had not just a boom but virtually a bubble between 2003 and 2013 for a period of 10 years. Now, it is true that in 2008, we had the global financial crisis. India too was affected by that crisis. But compared to many other countries of this world, India got off lightly. There was a stock market fall, a sharp fall, but there was also a recovery. Ditto for the economy. We were in the happy position of having a V-shaped recovery, something that all economists love. You have everything that is going on well. Suddenly, there is an unexpected crisis, the global financial crisis. In that case, the economy plummets, the stock markets plummet. But then you have a rebound. It's like a V, the letter V. It's not a U where you have stagnation for some time. So this V-shaped recovery that we had, by the time we came to 1 or 2 years after the global financial crisis, the economy was humming again. But what has happened after that is we have been facing a serious debt crisis which the government has not addressed, at least not addressed successfully. And as a result, the NPAs and the health of our public sector banks has been really bad. Now, the government's measures to address this issue, that's the debt crisis, were woefully inadequate, especially in dealing with non-performing assets of the public sector banks. Then came the COVID-19 crisis, which shattered economic activity. This called for immediate stimulus as well as budgetary support. Budgetary measures were required to elevate spirits, boost morale, and kickstart economic activity. Finance Minister Nirmala Sitharaman chose the borrow and spend approach in Budget 2021. How do you borrow and spend? You run a large fiscal deficit, as we saw in one of the previous slides. You don't care if for a year or 2 or 3, the fiscal deficit balloons. But we are going to borrow money and we are going to spend. Because only by spending can we get the whole economic engines start working again. This was a robust response to calls for a demand stimulus. Most economists were of the opinion that we need to stimulate demand in the country, for which we need liquidity, for which we need the government to start spending money. And if the government cannot raise this money from its revenues, then it has to borrow. This time's budget proposals were not presented as giveaways to the poor or tax breaks to the middle class. I'm completely aware that most middle class citizens, such as the people who are attending this analysis, were disappointed that there is nothing in it for them. But sometimes the stimulus to the larger economy, without specifically giving freebies to certain sections of the society, is more important to have a positive fallout on the economy from which everybody can benefit a little later. So this was a good move. Don't keep favoring, don't give sops to certain sections of the society. Instead, the finance minister chose the classic textbook method of spending heavily on infrastructure in the hope that it will have a trickle-down effect across the economy. This will work only if India can find a vaccine for one of its hitherto incurable viruses. That is pathetically poor implementation. This is not the first time we are seeing a budget that ticks all the economics boxes. From the point of view of an economist, it's a good budget. But our problem is that the success of the budget, the outcome of the budget will be good only if the budget proposals are satisfactorily implemented. Now, across not years but decades, regardless of which government it is, implementation has been pathetic. And this is the story of our implementation. Our track record of inertia, delays, multi-level leakages, and poor outcomes must be overcome. If this is not done, our fate may best be described in the words of the Scottish bard Robert Burns: "The best laid schemes of mice and men gang aft ugly." Or, to translate it from some of the Scottish words there, the best laid plans of mice and men often go awry. Let's come to personal income tax. Once again, we start with a little humor because income tax can be very taxing. The difference between the long and short income tax forms is simple. If you use the short form, the government gets your money. If you use the long form, your tax consultant gets the money. When we look at the union budget, this meme on the internet best captures how a middle-class person views the budget. The budget speech starts at 11 a.m. and it can go on for as long as 2 to 2.5 hours. But it is sometime during the first 1.5 or 2 hours that the direct tax proposals will come out. and the middle class waits and waits and waits to see whether there is any kind of tax relief, either on the investment front or the tax front or the lowering of tax rates or the increasing of the basic exemption. But in this year's budget, there are no changes in income tax rates. There is only one budget proposal, and not a very useful or significant one at that, for reasons I will tell you. Senior citizens over 75 years having only pension and or interest income need not file returns. But this is not at all as senior citizen friendly as it looks. Let's dig a little deeper. There are now 3 age categories of senior citizens for income tax purposes in India. 60, where you get a higher basic exemption of 3 lakhs instead of 2 lakh 50. 75, where you do not need to file income tax returns if the only income you have is interest and pension. And 80, the super senior citizens, where you have a basic exemption of 5 lakh rupees per financial year. Now, in the case of this year's amendment pertaining to the people above 75, the paying bank will deduct the necessary tax on income. The bank will take into account applicable deductions under Chapter 6A while computing the tax liability of eligible seniors. Tax rebate under Section 87A, that is relief to those whose total income does not exceed rupees 5 lakhs, will also be considered. So, till here it is, the bank is going to don the mantle of an income tax return preparer. The bank will take into account whatever deductions you are claiming. Have you made some investment in an ELSS fund? Have you made an investment in the public provident fund or a tax saving bank deposit? Plus, if your total income does not cross 5 lakhs, you have a rebate of Section 87A up to 12,500, which means essentially that if your income does not cross 5 lakhs, taxable income does not cross 5 lakhs, you do not have to pay income tax. So the bank is now expected to perform the role of an income tax preparer. But now the danger starts. The fine print says that the exemption is available only to those who earn interest from the same bank in which they receive pension income. All your deposits and your pension should be in the same bank. If the pension account is in one bank and the fixed deposits are in another or other banks, they may have to continue to file income tax returns. Given the state of most of our banks, which are quite shaky, it would very definitely be advisable not to have all your accounts and all your deposits in the same bank. Diversification is excellent. This little facility of not having to file a return is not at all an excuse to give up all your deposits and accounts from other banks and load them into just one bank. I would not advise that at all. Also, the filing of returns is not too difficult. If it is difficult, please take the help of a good chartered accountant or even an income tax preparer, income tax return preparer. It's not so difficult. Also, it has been stated that the government will be notifying a few banks for this purpose. So, it may not be for all banks. You have to be careful. You have to do a lot of ascertaining. To get the exemption, the eligible senior citizens will have to furnish a declaration to the specified bank. When we look at all this fine print, this is not at all a gift to senior citizens. My advice to everybody who is 75 years of age or above is, first, invest sensibly, safeguard your money. If you have been filing income tax returns so far, look at what process you have adopted to file the returns. If you are comfortable with that process, please continue with it, regardless of whether you have only interest income and pension income or otherwise. The next aspect of income tax that I want to analyze is the government's obsession with pre-filled forms. Personal details of salary, tax paid, tax deducted at source, etc. come pre-filled in the tax return forms in the past few years. Now it is proposed that details of capital gains from stocks, dividend income, and interest from banks and small savings schemes, among others, will also be pre-filled. To the extent that this actually reduces repetitive form filling, it is welcome. But I want to point out one aspect of trying to suck out all information from everywhere like a giant vacuum cleaner and then pre-filling forms. I would be very interested in knowing how the forms are going to be pre-filled, especially when it comes to dividends on stocks and capital gains from stocks. What if the stocks were purchased long ago? Is the government going to calculate the highest market value of these stocks on the 31st of January 2018 and compare that with your sale price and do the mathematics and pre-fill your return? If so, how is the government going to tackle issues like rights shares, bonus shares? When bonus shares are sold and fractional entitlements are paid to you, how is the government going to distinguish between a fractional entitlement payment and a dividend payment? How is the government going to keep a track of companies that change their names? What if you started out with one company, but later on the company has merged with another company? Amalgamations, mergers are a fact of corporate life. The name of the company changes, the structure changes, the cost of acquisition many times cannot be ascertained properly. I would be very interested in knowing how the government is going to do this. And if the government makes a mistake and you as a shareholder, as a taxpayer, rely on your pre-filled form, if the income tax department comes back at you detecting a mistake tomorrow, who is going to be held responsible? These are questions that I would ask, and I would be very interested in knowing the answers there too. If you want my own advice, I would say that everybody must keep their own records. You can make use of this whole pre-filled business to perhaps compare and reconcile. But I'm afraid that if a mistake is made, the government may not say, yes, it is our mistake, therefore you have no consequences. I think the ultimate onus will be on the taxpayer. One genuine SSE-friendly move is the torture of reopening assessments, sometimes for trivial amounts and for minor reasons. There is a reduction in the time limit for reopening assessments. It was 6 years formally, now it is 3 years, and this is very definitely welcome. For serious fraud cases, where the concealment of income is rupees 50 lakhs or more, the time limit is 10 years. This is perfectly okay. If there are serious income tax evaders, action should be taken against them, and if their returns are going to be reopened across a much longer time, it is perfectly okay. But there are many normal taxpayers who unwittingly would commit one or two minor mistakes. And sometimes this whole thing is brought up several years after it has happened, and then they are hard pressed to run about finding the documentation to either prove or disprove the whole allegation or the demand for excess taxes. So this time limit for reopening of assessments, the reduction in it from 6 to 3 years, is a genuinely good move by the government, genuinely taxpayer-friendly move. Another reasonably good and taxpayer-friendly move is, or investor-friendly move also I would say, see, nobody can predict in advance how much dividend a company is going to pay. Very difficult to estimate this. You can only guess it. And that's what people have been doing in the payment of advance taxes. But now the government says from the next financial year, advance tax liability on dividends will arise only after dividends are actually paid. This is a good move, especially for people who earn huge dividends from a few companies. If you have a well-diversified portfolio of 60, 70, 80 leading stocks, you'll be surprised to know that dividend payouts across a diversified portfolio are quite stable. You can even estimate them with a fair degree of accuracy. But if you are a major shareholder in very few companies, sometimes there can be violent fluctuations in the dividends you receive each year. This makes it very difficult to compute and pay advance tax. Now, this is a very taxpayer-friendly move. Now we come to another interesting aspect of this budget, that is faceless ITAT. ITAT stands for Income Tax Appellate Tribunal. It is the final body to decide about tax matters, short of the Supreme Court, of course. Let us understand the background and context in which this has been announced. Virtual assessment was introduced last year. Faceless first appeal is also in force. If you're not happy with the assessment, you can go on appeal. That is also in force. Both are faceless. An attempt is being made to harness technology and eliminate human interface. This is good, provided the principles of fairness and equity are not eroded. But such exercises should not become arbitrary and or one-sided. That's the danger. As we go along, everything the government's word is final. That kind of a thing should not happen, and there always is a possibility that it could happen. Now, this, what you see on this slide, is the situation as we have it today. What is the big change that is sought to be made? The Finance Bill 2021 seeks to transfigure the Income Tax Appellate Tribunal, or ITAT, in the same manner. Thus, the final fact-finding authority will also be made faceless. But this is being done without giving time for the faceless assessments and faceless first appeals to settle down. We do not have enough experience in judging how the faceless assessments and faceless first appeals are actually working in practice, whether justice is really being delivered, whether the assessments are being fairly conducted. Faceless assessments can be beneficial for simple matters, but it is quite a different story for complex disputes that ultimately reach the ITAT. The challenges include lack of adequate infrastructure for uploading data, limitations on file size, number of documents, difficulties in explaining complex facts or business structures, intricate legal aspects, etc. Believe me, any matter that reaches the ITAT is by nature complex. There's a lot at stake. Justice there has to be given in detail. It cannot be decided or handed out summarily or arbitrarily. Personal hearing, which is important in any administration of justice, has become an illusion. Unfortunately, in the proposed faceless ITAT system, the grant of personal hearing is not a matter of right. Approval has to be obtained from the Chief Commissioner of Income Tax or the Director General of Income Tax for grant of personal hearing. And this appears to militate against the principles of natural justice. The principles of natural justice say that justice should be available for all easily. And one of the fundamental tenets is that you have a right to appear and explain things in person or through a duly constituted representative like an advocate or even for income tax purposes, a chartered accountant. This, I'm afraid, is under quite a bit of danger if we are really going to implement the faceless ITAT. Where ULIPs are concerned, unit-linked insurance plans or unit-linked insurance policies of insurance companies, ULIPs with premiums of more than 2.5 lakh rupees per year will be taxed like mutual funds. This is applicable to ULIPs sold on or after 1st February 2021, so it is already in force. Amounts received on death shall remain tax exempt regardless of the quantum of premium. That is quite a fair clause in an insurance product. This is a welcome leveling of the playing field vis-a-vis mutual funds. If you see the way unit-linked insurance policies are structured, they are nothing but mutual funds. But where taxation is concerned, one did not have a long-term capital gains tax on it, and the other, the mutual funds, they have got short and long-term capital gains tax. And therefore now an attempt has been made to level the playing field. It is not fully level because still there's a 2.5 lakh exemption given, but whatever it is, it's a very welcome step in the world of investment. Interest on employees' provident fund contributions over rupees 2.5 lakhs will be taxable from 1st April 2021. This provision could impact contributions to the voluntary provident fund also. So everywhere the government is trying to raise money one way or the other. And whether somebody is a reasonably well-to-do person or not, my own opinion is trying to hit at a retirement corpus is not very fair and not very desirable. No disincentive should be given for savings, regardless of whether the person is rich or poor. You can have disincentives on things like lavish spending, luxury items, yes. But somebody putting by money for the future, it is being used for a productive purpose. And therefore, my own opinion is this particular measure is not at all a desirable measure. Coming to real estate, a small but significant issue here. Nothing new. It's only an extension of an existing facility. Let us understand the facility. First-time buyers seeking home loans on affordable houses. That has been defined as a house valued up to rupees 45 lakhs. Were eligible for a deduction of rupees 1.5 lakhs on interest paid during financial year 2019-20 under Section 80 EEA. So if your house the cost of your house does not exceed 45 lakhs or an apartment, you could have, if you're taking a housing loan on it, you could have an additional 1.5 lakhs of interest deduction, and this was in addition to the deduction under Section 24. Now this deduction was first announced in 2019-20 and it was only for that 1 year of 2019-20. What happened in 2020-21? The budget extended it for 2020-21. That is the financial year that we are living through at the moment. Now this budget has given a further extension to 2021-22. Clearly, there is an intention to give incentives for low-cost housing which is certainly good. One very interesting aspect when we turn to business, and that is the concept of one-person companies. Budget 2021 proposes to incentivize one-person companies or OPCs. The objective is to boost startups and innovation. Somebody wanting a really risky venture but wanting to protect himself or herself from unlimited liability. Total control, lower compliance burden, and limited liability are the advantages of an OPC. An OPC is nothing but something like a humble sole proprietorship at a sophisticated level. Many times I don't want to form a partnership or a company because I want total control, especially when I have a very innovative idea and I would like to reap the benefits of the profits that I perceive that idea will generate. So control is one factor. Lower compliance. As a one-person company, I do not want to have the onerous compliance of the Companies Act. I want simple and minimal formalities and limited liability. If things go wrong, I want my liability to be limited only to the extent of my capital in the business. Now, all these three can be given to someone in the form of an OPC. The exact modalities we'll have to wait for, but this is the thrust of the OPC. And so far we had something called small companies, which were given some benefits. Now the small companies thresholds have been greatly increased because the OPC is coming in. The definition of a small company has been amended. The threshold of share capital of small companies, which was 50 lakh rupees, has now been increased to 2 crore rupees. The threshold of turnover of small companies, which was 2 crore rupees, has now been increased to a much more impressive 20 crore rupees. Many companies which we formerly said were almost medium are now defined as small. Residency limit for an Indian citizen to set up an OPC is proposed to be reduced from 182 days to 120 days. In these days where technology flows across borders, if somebody is very innovative in the field of technology, this person may need to travel quite a bit, whether from India or outside India. And there can be sometimes a cloud over his residential status for a given financial year. Here, it is made much easier for an Indian citizen. Even if you are here for 120 days, as an Indian citizen, you can set up an OPC. Not only that, NRIs are also allowed to set up OPCs in India. These are all excellent measures. As OPCs grow, they can be converted into private limited companies if and when required. This is a good move. We talk of innovation, we talk of startups. A lot of startups also start small. A lot of encouragement must be given to them, even systemic encouragement. The right structures should be provided in the forms of business organization. So the right structures for business organization must be provided. And this whole move of the OPC is good. I only hope that when we read the fine print on the OPCs, it will not hamper or discourage people from actually setting these things up when it is required. Now, the tax audit threshold. Here is another very good move that will reduce the compliance burden on small businesses. Budget 2020 itself, the last year's budget, had done some good work here. It had increased the limit for tax audit and filing of a tax audit report. That's a special kind of audit the moment your business turnover exceeds a certain limit. So the old threshold was 1 crore and last year's budget increased it from 1 crore to 5 crores. Budget 2021 has doubled the limit, this is the turnover limit, to 10 crores. So two budgets have given a 10 times increase in the turnover limit for being exempt from a tax audit. It is going to help a number of small businesses, there is no doubt about this. But there's one proviso, and it's a reasonable proviso and condition. This is subject to the condition that cash receipts and cash payments during the year do not exceed 5% of the total receipts or payments. There is also a move to reduce cash in normal business transactions, and that is welcome. Coming to the securities markets, on the regulatory front, there is a major announcement. The SEBI Act, Securities and Exchange Board of India Act 1992, the Securities Contracts Regulation Act or SCRA of 1956, which was the main securities legislation in India, and the Government Securities Act of 2006 are to be merged into a single code. Now, the big implication is that the regulation of government securities or gilt-edged securities will pass from the Reserve Bank of India to SEBI. So the SEBI ambit of regulation will now expand. Hopefully, this will better integrate the government security, currency, derivatives, and equity markets. After all, debt and equity are the two asset classes most commonly used in personal asset allocation. It may make sense to have a common regulator for both these asset classes for all investment and investment-related aspects. Another big implication is that retail investors will get direct access to both the primary and secondary government security markets. Retail investors will be allowed to open gilt accounts with the RBI. In the United States, retail investors can purchase G-Secs, including Treasury Inflation Protection Securities or TIPS, directly from the Federal Reserve. In the US, there is a beautiful security available. In India, they tried to introduce it, but it has not taken off at the retail level. TIPS, Treasury Inflation Protection Securities. It is safe because it is guaranteed by the government, so it is safer than, let us say, a bank deposit. How does it work? Your money or your principal increases by the rate of inflation, but you are given a very low rate of interest. Let us look at an example of how a Treasury Inflation Protection Security would look like in India. Supposing you invest 10 lakh rupees in Indian TIPS. When you look at the interest rate may be a paltry 1%. That's all you're going to get, 1%, let's say. That means on 10 lakh rupees, I get 10,000. But a year passes. In that year, let us say inflation was 6%. So what's going to happen now is, your principal value of 10 lakhs becomes 10 lakh 60,000. In other words, the government seeks to protect the value of your money, especially to the extent that it is battered by inflation. So these are beautiful securities for people who want to preserve their money, at the same time not take risks like going for real estate or the stock market. Of course, taxes and other things on these have to be worked out. If they are going to be taxed mercilessly as capital gains as well as on income, then they are really not going to fulfill their objective of protecting you genuinely against inflation. But unfortunately, we don't have them here. In the US, the excellent facility that ordinary citizens have is they can directly purchase these securities from the Federal Reserve, which is the Reserve Bank of the United States. In India, in the wake of the government's massive rupees 12 lakh crore borrowing program in financial year 2021-22, it is advantageous for the government to have wider participation and an expanded investor base in government securities. But investors need to be educated about the nuances of the G-Sec market. Government securities, you can lose money in them if you buy and sell. The only investor who will not lose in government securities is someone who buys the government security and holds it till maturity. You will get the principal back, you will get your regular interest payments generally once in 6 months. But many times, the life of government securities is very long. 10 years, 20 years, it can be even 30 years. What if you need money in between? There is no buyback with the government. It is not like a bank fixed deposit where you can go to the bank and prematurely encash it. Your only option is to sell it in the bond market. And in the bond market, depending on what the interest rate is at a given time, you can lose. For example, if you purchased a 6% government security, but over time the interest rates have gone to 8%, the value of your bond decreases. Government security prices and interest rates vary inversely, not proportionately. So higher the interest rates, lower the bond prices, lower the interest rates, higher the bond prices. So if you're not careful, if you don't have the minimum expertise and knowledge, it could be risky to invest in government securities. So investor awareness and investor knowledge about government securities will be very important before you venture into retail purchase of government securities. I now turn to reforms and liberalization in various aspects of Union Budget 2021. The first is banking. There is a proposal to set up an asset reconstruction company, or ARC, to take over stressed assets of banks. Rupees 20,000 crores has been set aside to recapitalize public sector undertaking banks. But when you compare this figure with the potential NPAs that are there in the system only with PSU banks, 20,000 crores is a drop in the ocean. There is also a proposal to privatize 2 more PSU banks in addition to IDBI, which is already underway. Non-performing assets of public sector undertaking banks in particular showed a sudden massive spurt of more than 90% in financial year 2015-2016. That's the year from which our economy started taking a downturn. The real estate boom ended in 2013. A lot of loans given to the real estate sector, infrastructure sector started going bad. And that played havoc with the Indian economy long before the pandemic, for which we have a convenient excuse in this financial year. And not only did these non-performing assets spurt in 2015-16, they have stayed high ever since then. Public sector undertaking bank mismanagement, coupled with political interference, has always been a prescription for disaster, and disaster has indeed occurred. Now, an asset reconstruction company or a bad bank is proposed. In common, it is known as a bad bank, but that's an unfair term. This is not a bad bank. This is actually a good bank. It is an organization which takes over stressed assets, bad assets, and tries to recover the maximum it can. So it's doing some good to the banking system. What will it take for the asset reconstruction company to solve India's PSU bank and NPA crisis? Let's look at that. First, the ARC must be a strong, independent, transparent, and professionally managed institution without either bureaucrats or politicians in it. We have to ask ourselves the question, is this going to be possible in India? Second, it must have a well-crafted execution plan to solve the bad loan crisis. Third, and this is a very important point, it should be a special purpose vehicle to be wound up within a definite period so that a sense of urgency is induced in its operations. Ideally, banks should have non-performing assets of less than 5%. If you look at the average of the private sector banks, that's about 5%. If you look at the foreign banks in India, the NPAs are less than 5%. If you look at the public sector banks, even without the window dressing and hiding things, we have virtually something hovering around 10%. This is alarming, and this situation is not being addressed. The can is just being kicked down the road. So here, once you form a bad bank or an ARC, the ARC should not have infinite existence. We should say 3 years, 5 years, within this time you have to set it right and you have to be wound up. Otherwise, it will be given extension after extension and nothing will happen. Once again, we will sink into inertia. Fourth, it must be backed by fast-track judicial processes. For example, as envisaged under Chapter 4 of the Insolvency and Bankruptcy Code 2016. We have the legislative framework. Our whole problem is implementation. Fifth, not just adjudication, not just deciding of cases, but also recovery processes and mechanisms must be quick, efficient, effective. I've got an order to take over an asset. I must now have a plan and a framework and a mechanism to liquidate it, to get the best value for it in the shortest time possible. What is the conclusion on this whole proposal of the ARC? Undoubtedly, it is welcome. Success of the ARC's operations will jumpstart the economy. Today, it is the non-performing assets of mainly our PSU banks that are acting as some kind of burden on the whole economy. They are keeping the economy down. So success in the ARC's operations will jumpstart the economy, but failure will prove exceptionally costly. One of the world's most respected news magazines, they call themselves a newspaper, The Economist. In its 30th January edition, it asks this question: will India's government act to save its public sector banks? And it has there on top, the end of the road nears. What its meaning is and what that article says is, if they continue ignoring the problem or neglecting it or disregarding it, you'll suddenly one day wake up with actual PSU banks imploding and PSU banks failing, and that can have a cascading effect on the economy. The economy will kind of self-destruct. It will be very difficult at that time to come to its rescue. But once again, the article says that when you explore the options, there are few options that are palatable to both investors as well as the government, because their whole objectives are different, their interests are different. Deposit insurance. There is a very good move here by the government. I'm surprised why it was not brought in earlier. Deposit Insurance and Credit Guarantee Act is to be amended. What is this amendment? Depositors of troubled banks will have access to their deposits and money in their accounts to the extent of rupees 5 lakhs, the maximum insurance cover. All deposits, all accounts in the same bank, whether they are savings account, recurring deposits, fixed deposits, whatever, are protected to the extent of rupees 5 lakhs per person or per entity. Now, when you have got this insurance, the way people were troubled is, in case the bank goes bad, the first thing they do is suspend accounts. You cannot make any withdrawals from the bank. Then slowly they will allow 10,000 rupees per day or 15,000 rupees per day. But the fact remains that you are covered by insurance to the extent of 5 lakh rupees. Now, the amendment in this budget is excellent. It is a banking customer friendly amendment. You will have access to your money to the extent of 5 lakhs. Public sector banks, private sector banks, cooperative banks, and small finance banks will be included in this. Only thing is, how do you ensure that your bank is paying the deposit insurance premium every year? I wish the government also focuses on this so that people are not suddenly left high and dry. Where insurance is concerned, there is an increase in foreign direct investment in insurance companies to the extent of 74%, along with full foreign ownership and control subject to certain safeguards. This is a good move in capitalizing the insurance sector further, in getting more innovative products. In foreign insurance companies coming here, it's a very liberal move by the government. Now we come to another important aspect of economic growth: financing development. And here there is a major move. A development financial institution, or DFI, is to be set up for project funding. The concept of a DFI is not new to India. In 1948, you had the Industrial Financial Corporation of India, or IFCI. Later, there were two other well-known entities, ICICI and IDBI. These are the parent companies of today's banks. But these companies transformed themselves into universal banks and lost focus on infrastructure lending, which should be the main focus of a development financial institution. DFIs have an important role to play. They are not going to deal with normal individuals as customers. Their whole focus is on project finance, on large infrastructure projects. Therefore, they can be government owned. There is no problem here with nationalizing them right from the beginning. They can contribute to economic growth because they can take risks which commercial institutions like banks cannot take. But they should be strong institutions. They should have independence and integrity and be managed by individuals with the right skills and capability. That is where we fail. Because in India, we persist in weakening institutions. We do not like strong institutions. The politicians, the political parties, even the bureaucrats see strong institutions as a threat, not as an asset which can take the country forward. Will this happen in India? This is a question. In India, we had a case where one of the world's finest economists, Dr. Raghuram Rajan, was the governor of the Reserve Bank. But he is a person who will speak his mind. He doesn't care whether what he speaks is liked by the government or not. And in this process, the ruling dispensation was finding it uncomfortable at some of his utterances, and therefore his term was not renewed, and he went back to teaching in the United States. It was our loss. That was followed by the resignation of the next RBI governor, Dr. Urjit Patel, when his thinking as an economist clashed with some of the political objectives of the government of India. Once again, we are not good at living with strong, independent institutions which are necessary for any healthy democracy or any healthy government. We also have another incident. This was, I think, in 2019, early 2019, when two respected statisticians from the National Statistical Commission, P.C. Mohanan and J.V. Meenakshi, I think P.C. Mohanan was the acting head of that institution, put in their resignations over a quarrel with the government because they had published figures. They had published figures about unemployment being at its highest. The government thought that these figures, if published, will embarrass it, and therefore it was trying to delay the publication or trying to keep those figures under wrap. So these two people quit. Like I said, we are not very good at building strong institutions. Therefore, I am not very sure about exactly how this proposed development financial institution will actually function in the current environment we have in India. One good thing on another note here is debt financing of infrastructure investment trusts, also called InvITs, and real estate investment trusts, also called REITs, by foreign portfolio investors could help increase liquidity in the real estate segment. Whenever you talk of infrastructure, real estate is also an important part of infrastructure. A lot of infrastructure is based upon real estate. So there are two vehicles in the private sector which can bring in serious money for meaningful development, and the government has nothing to do here. The government has only to play a role of facilitating smooth flow of funds into real estate. And the government has done at least this in the budget. Debt financing is now allowed by foreign portfolio investments into InvITs and REITs. Real estate being an essentially illiquid investment, such measures are welcome. Something good for gig economy workers. As the world economies grow more dynamic, you are going to have a class of people who are neither full-fledged employees nor are they completely independent entrepreneurs. They are somewhere in between. Take your Ola and Uber drivers. They are dependent upon a company, they are affiliated to a company, their income does come from that company, but to a certain extent they are independent operators. If somebody does not want to work one day, he just does not switch on his app. So to that extent they have independence. They can work when they want to, for whatever hours they want to. But at the same time, without the company, they are nothing. So for such temporary workers, gig economy workers, there's something good in this budget. Workers in the gig economy to get social security. A portal is being set up on which gig economy workers can register and become aware of schemes relevant to them. Minimum wages and health benefits under the Employees State Insurance Corporation or ESIC are expected to be the main benefits. Gig workers and construction workers, including migrant labor, could benefit from health, housing, skilling, insurance, credit, and food schemes. I really hope that this comes to pass on the implementation stage, because here are a large number of people who belong to the lower middle class and actual poor sections of the society. And they require a lot of protection and a lot of comfort, especially in the difficult times. For employers, the finance minister has promised that the compliance burden will be reduced with single registration and licensing and a provision to submit returns online. If these two things happen, genuine, meaningful, relevant benefits to gig economy workers on the one hand, and second, where the employers are concerned, don't burden them too much with compliance, with bureaucracy. Make things easy. If you have got online systems for filing returns, for checking and inspection, well, we could have something good happening in this whole sector. I come to economic growth. There are big increases in allocations to capital expenditure and health. And both these are essential for the economic growth of any country. This is one of the main features of Budget 2021. A massive 34.5% increase in capital expenditure. It goes up to a record 5.54 lakh crores, up from the old 4.12 lakh crores. Outlay on health is up by 136% to rupees 2.23 lakh crores from rupees 0.95 lakh crores. This is especially in response to the pandemic, but it is also very essential that expenditure on health in this country increases and the outcomes are also delivered more effectively. India spends just 1.2% of its GDP on health. This is far below the government's own stated goal of 2.5% of GDP by 2025. If you want context, Sri Lanka and Bhutan spend 1.6% and 2.5% of their GDP on health, respectively. Let's look at disinvestment. This is a term that has been used for decades now. For the first time, we had the word privatization used in this year's budget. But that still begs the question, will the result be any different? Let's look at disinvestment or privatization a little closely. Budget 2020, the previous budget, had a disinvestment target of rupees 2,10,000 crores, quite ambitious. What was the reality? As of today, of course, the financial year is not over, but as of today, just 1.5 months away from the financial year, only 31,000 crores has been achieved out of 2,10,000 crores targeted. Of course, there was the COVID-19 pandemic, and yes, the COVID-19 pandemic has resulted in a setback to disinvestment. But while it is easy to blame the pandemic, let us understand that the economy got a shock for the first 6 or 7 months, let us say between March of 2020 and September, October of 2020. Yes, the economy was in bad shape. But everyone is resilient, human beings are resilient, and economic activity has almost come back. I will not say to normal, but it has made a comeback in the 3 or 4 months that have followed. The stock markets have gone up. The opportunity of disinvesting public sector undertakings in a booming stock market has unfortunately been squandered. The government could have got its act together. It knows the process of how to disinvest. In the last 3 or 4 months, or in the remaining half of the financial year, taking advantage of good stock market conditions, a lot more could have been done. I'm not saying the target of 2,10,000 crores would have been achieved. But even if the government had managed half of that, it would be excellent. Budget 2021 has a privatization target of 1,75,000 crores, less than the old target. 2 public sector undertaking banks and 1 public sector undertaking general insurance company are sought to be privatized. The finance minister has also proposed an asset monetization program of government assets ranging from railway operations to sports stadiums. If they can do this, it will be excellent, more revenues. Where disinvestment or privatization is concerned, the problem, as always, will be implementation. Implementation and final outcomes will be a recurring theme in whenever you speak about the budget. Conceptually, the budgets can be good. In practice, many times they are wide off the mark. So far, disinvestment achievements have mostly fallen well short of targets. If you look at this graphic on disinvestment, the black line is the target, the orange line is the actuals. There have been very few times in the last, this is 20 years, please note the last 20 years, just 2 or 3 occasions when the disinvestment targets were actually exceeded meaningfully. And if you come to recent history, you can see the yawning gap between the target and the actuals. So this is alarming, and now we are targeting 1,75,000 crores. Can the government do this? Is the question. The examples that we have before us are not encouraging. For 3 years, the government has tried and failed to privatize Air India. For 6 years, the government has tried and failed to privatize IDBI Bank. The deadline for disinvestment of Bharat Petroleum Corporation Limited has been extended several times. What the government does not seem to realize is that greater the delay in privatizing, greater the deterioration in the quality of assets sought to be sold. So, lower will be the prices realized. This is one thing that the government just does not seem to understand. If Air India had been privatized 10 years ago, you would have got a much better price. But the damage has been done across time. The deterioration keeps setting in, and that is going to, there may come a time when nobody wants to buy it. Nobody sees value in it. So, there should be a sense of urgency in privatization and disinvestment. The government has many times no business to be in certain types of businesses. Furthermore, there are internal contradictions within the government that may be stumbling blocks to disinvestment. Certain factions and groups in the ruling party or close to it are not in favor of privatization. It's not just the opposition. The Bharatiya Mazdoor Sangh, BMS, that is affiliated to the BJP and the RSS, has already announced its opposition to privatization. So you are having problems within your own ruling dispensation. The Swadeshi Jagran Manch, SJM, and many in the RSS also oppose certain aspects of disinvestment. The government may not have a free hand in taking disinvestment forward. Disinvestment is critically important in financial year 2021-22 because the government is banking heavily on privatization proceeds to balance its books. But implementation will continue to remain the elephant in the room. So let us come to some kind of a conclusion on Budget 21-22. A nice little cartoon here. Genius is 1% inspiration, 99% budget allocation. This is true to life, even at the personal level or elsewhere. If you allocate your money wisely, you will get the best returns. This is more an economist's budget than a politician's budget. The political element was in the large outlays for new highways and metro projects in the pole-bound states of Assam, Kerala, Tamil Nadu, and West Bengal. So those SOPs for the pole-bound states have been given. This apart, the government has quite rightly assumed the responsibility to maintain momentum in growth and keep the economy going in difficult times. The tragedy is that India needs a good crisis for economics to prevail over politics. Most of the good budgets, the budgets that we can call economists' budgets, come only when there is a crisis, when things are bad, when situations look bleak. Raghuram Rajan, in mid-January, he had a prescription for this year's budget. 3 things he recommended: prioritize spending, boost infrastructure, sell PSUs. Fortunately, in the budget at least, the government has heeded the advice. The spending is largely well prioritized. Huge boost and huge investments in infrastructure in the hope that these large projects will have a trickle-down effect on the economy. And they have at least shown an intent to sell PSUs. We'll have to see whether it actually works in practice. When we talk about the sources of government finance, given the present state of the economy, fresh and or increased taxes were not an option. So the alternative is borrowing to spend. That's what the government has done. That's why the high fiscal deficit. Gross borrowing in financial year 2021-22 is rupees 12 lakh crores, approximately the same level as in the previous COVID-affected financial year of 2020-21. So get this straight, we are having 2 consecutive years of massive government borrowing. Even the figures of government borrowing in the financial year 2020-21, the one we are living through, and the next financial year of 21-22, even the figures are the same, 12 lakh crores roughly in each of these financial years. That's a gigantic borrowing program. And a gigantic borrowing program can have risks because borrowing is demand for money. I need money. That's when I borrow. When I borrow, the price of money will go up. Any first month economics student will tell you, when there is a demand for something, the price goes up. The price of money is interest. So when you borrow, the interest rates are likely to go up. Yields on the 10-year government bond went up by 0.13% to 6.06% on budget day in the immediate aftermath of the finance minister's budget speech. Since then, of course, there have been fluctuations, but the bond markets are cautious. Where can an uncontrolled fiscal deficit take us? This is a question we ask and we should know. So let me just give you a very small economics lesson on this. The government must earn more and spend less. But what it does is spend more and earn less. Even worse, it borrows to spend. High government borrowing will lead to higher interest rates and more wasteful expenditure. It can also crowd out the more productive private sector. Crowding out means the government and the private sector are both competing for the limited amount of money available. Obviously, the government has more muscle. Therefore, the private sector gets crowded out. Higher interest rates means less borrowing by non-government sources. Less borrowing will mean less spending on consumption by individuals and less investment by businesses. Both individuals and businesses will tighten their belts. Less spending means less demand. Less demand means lower output. Lower output means lower growth. Lower growth means fewer jobs. Fewer jobs means lower demand, and the vicious cycle starts all over again. So this is one danger. The danger of economic recession fueled by high interest rates and high inflation is a danger that we have to watch out for. This nightmare scenario need not necessarily come to pass. Sufficient liquidity has been created in the financial systems of not just India, but all major countries of the world to combat the economic fallout of the COVID-19 pandemic. A lot of cheap money has nowhere to be profitably deployed at the moment. It is therefore finding its way into speculation in the stock market, the commodity markets, and the cryptocurrency markets. But inflation remains a threat, though it may not be a certainty. The Economist, in its most recent issue, the February 13th issue, has highlighted concerns about inflation, not just in India, but in the world. It calls it Inflategate, how rising inflation could disrupt the world's economic policies. And one more where it says, inflation will rise in the coming months, but will it be sustained? There's a lot of confusion here. There's a group of economists who actually believes that we can have prolonged low interest regimes, prolonged regimes of borrowing and spending without interest rates or inflation really going up. Nobody can come to a conclusion. Only the future will provide us with the actual answers. There is a concept in economics and statistics called Pareto optimality. Very simply put, there's a delicate difference between two concepts, Pareto optimality and Pareto efficiency. We'll take Pareto optimality. Very simply put, Pareto optimality is achieved when you have a situation where no one is worse off and perhaps some are a little better off. This has been managed by Budget 2021, at least conceptually. Thanks to the COVID-19 pandemic, fiscal consolidation was not on the agenda. People forgot about controlling the fiscal deficit. If the government focuses on implementation and outcomes, this may actually turn out to be one of the better budgets of recent times. The fact that conceptually it was an economist's budget, it was a bold budget, has been highlighted by the media. I've just given you one cover of the India Today issue on the budget, a bold new deal. It is true. What do I hope for as I look at the budget, as I studied the budget to talk to you about it? What did I wish for? I think I can bring it down to just one or two sentences. The budget or the budget day is only one day. But we have 365 days in the year. Forgetting this one day of the budget day, I hope the government and the powers that be focus on the remaining 364 days on actually implementing in true spirit the provisions of the budget. Then we will have taken a giant stride to have a much better economic situation in our country. Thank you. I just want to make one or two very small announcements. To receive a copy of this presentation, please email the email ID that I have mentioned, investments_sac@yahoo.com. This preparation of the budget presentation is not something that I've done only by myself. I've had tremendous support and encouragement from a lot of people who are close to me. I'm very grateful to three people from my office: my partner, Gerard Aranha, my wife, Disha Colaco, who heads our equities section, and Mr. Cyril Fernandez, who heads our mutual fund section. They very patiently went through the budget presentation and pointed out so many mistakes, which I corrected. I'm very grateful to them. Mr. Deepak Rao, one of India's leading mutual fund distributors, somebody I'm proud of to have had as a student and an intern in the old days, running today a fabulous investor-centric company called Simplus Financial Consultancy. He has taken giant strides in the field of investor education. He's even had a new organization called Simplus Learning Academy, at which it is an honor for me to sometimes teach. And it is Deepak who has provided the facilities and the infrastructure for the broadcast of this budget presentation. And two wonderful and very enthusiastic youngsters: Gavin Abner Pinto, who is the course coordinator at the Simplus Learning Academy, very interested in aspects of investment and insurance. He has coordinated the whole broadcast of this session. And Mr. Lizelle Aranha, a software consultant who was in charge of all the software and other infrastructure of this particular presentation. I'm grateful to all of them. Thank you.